So, in the first 3 months of 2026, humanity actually had a relatively mild flu season. Broadly speaking, we were just healthier.
Yeah, which is obviously great news for most of us.
Right. Far fewer people were checking into hospitals with, severe respiratory bugs compared to the previous winter. But because we were healthier, this sprawling corporate division operating out of Washington, D.C., watched its core sales drop by 4%.
Which is pretty significant.
Yeah, and it actually prompted this multi-billion-dollar scramble to basically reinvent their entire business model.
It highlights this really bizarre reality of the modern medical supply chain, I think, because the financial models of these massive healthcare conglomerates, they're fundamentally pegged to the volatility of human sickness.
Right.
So when the epidemiological weather patterns change, the corporate architecture just has to adapt instantly.
And today, our mission is to dissect the anatomy of one of those global behemoths. We are taking a deep dive into Danaher Corporation by cracking open their newly released Q1 2026 earnings report.
Yeah, the SEC Form 10Q.
Exactly, covering the financial period up through March 27, 2026. And as a quick side note for you listening, accessing this 36-page raw financial filing required us to pass a Cloudflare bot verification check from MarketBeat.
Oh, right, the CAPTCHA thing.
Yeah, we literally had to prove to the internet that we possess human souls just to gather the intel for this deep dive.
Which honestly feels entirely appropriate when you're looking at a document that translates, human illness and academic research and geopolitical conflict into these really sterile columns of revenues and expenses.
Totally.
A Form 10Q isn't just an accounting requirement, it's like a real-time stress test. It reveals exactly how a company navigates shifting supply chains, international trade wars, and just, shifting clinical demands.
Okay, let's unpack this. Before we pull apart the individual divisions, we have to look at the macro pulse of the organism.
Right, the big picture.
Yeah, so in the first quarter of 2026, Danaher pulled in $1.029 billion in net earnings.
Which breaks down to $1.45 per diluted share, I think.
Yep, $1.45. And that profit is derived from $5.951 billion in total sales for the quarter.
And just to put that in perspective, in the exact same quarter last year, so 2025, their net earnings were $954 million.
Okay.
So the top-line narrative looks like a massive win, right?
Yeah.
$1 billion in pure profit over 3 months. Total sales grew by 3.5% year over year. But in corporate finance, top-line growth can be a bit of an optical illusion.
Right, because when you look closer at the filing, their core sales only grew by 0.5%.
Yeah, exactly.
There is a massive 3% gap between total sales growth and core sales growth. And, understanding that gap explains a lot about how global commerce actually functions.
What's fascinating here is the outsized role of foreign exchange markets. Because multinational corporations are just heavily exposed to currency translation.
So they're dealing with multiple currencies all at once.
Right. Danaher manufactures and sells high-tech equipment all over the planet,
Yeah.
Germany, Japan, China, but they have to report their final earnings to the SEC in U.S. dollars.
Oh, I see.
And during this specific quarter, the euro and several other major currencies strengthened significantly against the dollar.
Meaning, if they sell, like, a centrifuge in Berlin for 10,000 euros and the euro becomes more valuable relative to the dollar, Danaher gets to claim a higher revenue number on their SEC filing without having sold a single extra centrifuge.
Precisely.
They essentially got a 3% financial bump purely from the math of exchanging currencies.
It's basically currency arbitrage disguised as growth, and that is why financial analysts absolutely obsess over core sales.
Because it strips all that out.
Exactly. Core sales strip out the currency fluctuations, and they strip out any recent acquisitions to show the organic yield of the underlying business. It shows you whether the actual physical volume of goods moving out of the warehouses and the prices they're able to charge for those goods are actually increasing.
So it's kind of like stepping on a scale while holding a bunch of heavyweights. Looking at total sales gives you one number, but core sales removes those weights, the currency fluctuations and the acquisitions, to tell us the actual body mass of the business.
That's a perfect analogy, yeah.
And an organic core growth of just 0.5% means the physical engine of the business is essentially flatlining. Yet, they still squeezed over $1 billion in profit out of it.
They did that through some really aggressive operational efficiency and pricing power in very specific niches.
Hmm.
But to understand how a flat core growth still generates $1 billion in profit, you can't just look at Danaher as a single entity.
Right, they operate as the collection of specialized segments.
Yeah, currently they have three main divisions, and the divergence in their performance is staggering.
So let's look at the undisputed heavyweight champion of their portfolio right now, which is biotechnology.
Oh, yeah, the star player.
This segment generated $1.797 billion in sales, delivering a massive 7% in core growth. This is the division that supplies pharmaceutical companies with the tools they need to manufacture biological medicines. So monoclonal antibodies, gene therapies, mRNA vaccines.
And the crucial mechanism driving that 7% growth isn't heavy machinery. Historically, biopharma manufacturing relied on these massive multi-story stainless steel bioreactors.
I've seen pictures of those. They look like breweries.
Yeah, exactly. And those required intense chemical cleaning and sterilization between every single batch of medicine, which meant massive downtime and a high risk of cross-contamination.
But the industry has been undergoing this huge shift toward bioprocessing consumables.
Right.
So instead of cleaning a giant steel vat, pharma companies are buying incredibly complex, sterile, single-use plastic bags. You line the reactor with Danaher's proprietary bag, brew the biological medicine, and then literally just throw the bag away.
It completely eliminates the cleaning downtime and the cross-contamination risk. But from a business perspective, it transforms a one-time equipment sale into this aggressive, recurring subscription model.
Of course, subscription models.
Yeah, once a large pharmaceutical company designs their FDA-approved manufacturing process around a specific Danaher resin or, a specific Danaher specialized filter, they are locked in.
Because changing it would require reapproval.
Exactly. They have to continually buy those high-margin consumables for the entire life cycle of that drug. And the filing specifically notes that strong demand for these consumables from large pharma, particularly in Western Europe and China, is basically carrying the entire division.
Okay, so biotechnology is their high-yield growth engine. But then we pivot to the second division, which is life sciences.
Right.
They brought in $1.737 billion in sales, but core growth was an anemic 0.5%.
Yeah, barely moving.
This is the division focused on the early-stage research side. So they sell the mass spectrometers and the microscopes that universities use to study DNA and proteins.
And the stagnation here really comes down to the fundamental difference between capital expenditures and operating expenses in academic budgets. The SEC filing clearly states that academic and government customers are facing significant funding constraints right now.
So when a university research department gets squeezed, the first thing they freeze is CapEx.
Right, the capital expenditures.
They will indefinitely postpone buying a brand new $3 million electron microscope. But they can't freeze their OPEX.
For the operating expenses, yeah.
They still have to buy the basic custom nucleic acids, the plasmids, and the daily filtration supplies just to keep their existing research grants active.
Which is exactly what the data shows. Equipment sales plummeted, but the consumable side of life sciences remains sticky enough to keep the division from going negative. It's essentially treading water.
Okay, which brings us to the third division, diagnostics. This is actually their largest segment by sheer volume, bringing in $2.417 billion.
But the core sales plunged by 4%.
Yeah, this is the clinical side of the business. The chemistry analyzers and molecular tests sitting inside hospitals and reference labs.
And there are two massive external forces compressing this division, and neither of them are within Danaher's direct control.
Okay, what's the first one?
The first is a structural change in the Chinese healthcare market. The Chinese government has been aggressively rolling out a volume-based procurement program, or VBP.
Right, so rather than individual hospitals negotiating prices for reagents and testing kits, the government consolidates the purchasing power of entire provinces.
Exactly.
They basically walk into a room with suppliers and say, look, we represent 100 million patients. We will guarantee you a massive volume of sales, but only if you slash your prices to the absolute bone. Winner takes all.
It is a brutal margin compression tactic.
Yeah.
And Western multinationals have no choice but to participate, or they get entirely locked out of one of the largest healthcare markets on Earth.
Wow.
The filing explicitly attributes a 2% price decrease across the entire diagnostics segment directly to this Chinese procurement program.
And the second force crushing their diagnostics growth goes right back to the scenario we opened with. The filing actually blames a less severe respiratory season. Wait, so because humanity had a mild respiratory season and people were generally healthier, Danaher's diagnostics core sales actually dropped 4%. How do these companies even plan for the unpredictability of human sickness?
Well, they kind of can't, because the general population experienced fewer severe flu and respiratory bugs in Q1 2026 compared to Q1 2025. Hospitals simply ordered fewer molecular respiratory panels.
That makes sense, but it's crazy to think about.
If your core revenue stream requires high viral transmission rates across the globe, you aren't just selling medical supplies, you are basically trading weather derivatives.
Wow. Yeah, it's an inherently volatile foundation.
Forecasting revenue for chemical testing means forecasting epidemiology, which is impossible. And the executive leadership at Danaher clearly recognizes that this level of unpredictability is just unsustainable for a company of this size.
So if your foundation is built on something as volatile as predicting winter flu spikes, you either accept the volatility or you go out and buy a completely different foundation.
Exactly.
And that is exactly what they just did. On February 16th, 2026, Danaher announced a definitive agreement to acquire Massimo Corporation for $9.9 billion.
If we connect this to the bigger picture, it is a masterclass in a strategic pivot.
$9.9 billion is a massive pivot.
Yeah, Massimo generated about $1.5 billion in revenue last year. But they don't sell chemical reagents, and they don't sell flu swabs. They are a premier manufacturer of non-invasive patient monitoring systems.
Like pulse oximetry, right?
Specifically pulse oximetry, yeah. They build the hardware and the algorithms that track a patient's physiological data in real time in the ICU.
So they're essentially buying their way out of the episodic chemical testing market and buying their way into the continuous digital monitoring market.
That's exactly the play.
A hospital might only run a respiratory test when a patient coughs, but a patient monitor is running 24/7, generating a constant stream of data and justifying a completely different kind of hardware contract.
It completely shifts their exposure. But orchestrating a $9.9 billion acquisition fundamentally warps the financial architecture of the parent company.
Oh, for sure. You don't just write a $9 billion check out of the corporate checking account.
No, definitely not.
Danaher currently has about $5.7 billion in operational cash on hand. To pull this off without draining their liquidity, the filing details some massive financial engineering. On April 16, 2026, they established a $5.0 billion 364-day credit facility.
And that 364-day timeline is crucial. It is essentially a bridge loan from a syndicate of major banks. They use this short-term facility to backstop their commercial paper programs.
And commercial paper is basically what? Unsecured short-term corporate IOUs?
Exactly. It's what large companies issue to raise funds quickly and cheaply. By securing this $5 billion credit line, Danaher proves to the market they have the liquidity to close the Massimo deal immediately.
It buys them the time they need to eventually issue long-term bonds to permanently finance the acquisition later. But just setting up the chessboard for this deal is wildly expensive. The SEC filing notes that in this first quarter alone, Danaher burned $17 million purely on transaction costs.
Oh, wow.
Yeah.
That is $17 million spent on investment banking fees, legal structuring, and antitrust filings like the Hart-Scott-Rodino process.
Right.
It's just capital vanishing into the friction of M&A before the ink is even dry on the acquisition.
So they're throwing nearly $10 billion at the things they can control, buying Massimo to fix their shrinking diagnostics portfolio. But the back half of this 10Q filing reveals the terrifying scope of the things they absolutely cannot control.
Yeah, the external risks.
Right. They're currently navigating a global minefield of geopolitical and legal risks.
And the physical supply chain is arguably the most vulnerable point there. The filing details how the ongoing geopolitical conflict in the Middle East is creating severe operational choke points.
Okay, how so?
Well, they're reporting tangible logistics delays and significantly higher costs for routing goods to their customers.
Because when you are shipping delicate, temperature-sensitive bioprocessing resins or highly calibrated mass spectrometers, you can't just put them on a slow boat around the Cape of Good Hope to avoid the Red Sea.
Exactly.
You often have to pivot to air freight, which basically obliterates your profit margins. Combined with the conflict driving up global oil and natural gas prices, the basic cost of doing business physically increases.
And while the physical supply chain is degrading, the regulatory landscape is shifting right under their feet. The financial reporting around international trade and tariffs right now is absolute chaos.
Yeah, and look, we have to look at the U.S. tariff situation purely through the lens of this SEC filing, remaining completely impartial to the politics, But the legal mechanics are just fascinating.
They really are.
In February 2026, the U.S. Supreme Court handed down a major ruling regarding the International Emergency Economic Powers Act, or IEPA. The court essentially ruled that the IEPA did not authorize certain broad tariffs that a prior administration had put in place.
This raises an important question for corporate accounting. What happens to the hundreds of millions of dollars companies already paid under those invalidated tariffs?
Good question.
Well, the U.S. Court of International Trade immediately ordered Customs and Border Protection to start processing refunds.
So for a brief moment, multinationals like Danaher were staring at a massive, unexpected cash windfall.
Right.
But the filing notes that the order was almost instantly suspended while Customs scrambles to figure out the sheer administrative burden of processing all those refunds. And simultaneously, the current U.S. administration announced their intention to implement entirely new tariffs using a different statutory framework.
If you are the chief financial officer trying to calculate your cost of goods sold for the next 12 months, it is a nightmare.
I can't even imagine.
You have the highest court in the land invalidating your past costs,
Ugh.
a lower court dangling suspended refunds, and the executive branch promising new inbound taxes.
It's like trying to navigate a massive cargo ship through a hurricane. But the laws of physics and the rules of the ocean keep changing mid-voyage.
That's exactly what it feels like.
You can't chart a course. You just reinforce the hull and hope you survive the waves. And if the external threats weren't enough, they are also dealing with internal legal turbulence. The 10Q provides an update on a major piece of litigation, Hawkins v. Danaher.
This was a securities class action lawsuit filed back in 2023. The plaintiffs alleged that Danaher's executive officers artificially inflated the company's stock price by publicly misrepresenting their revenue projections for the bioprocessing division.
Which traces back to the post-COVID whiplash, right?
Yeah, exactly.
When pandemic-era vaccine manufacturing started to cool off, large pharma companies stopped hoarding those single-use plastic bags and resins we talked about earlier. They started burning through their existing inventory, which caused Danaher's new orders to temporarily plummet.
Right, the destocking phase.
And the lawsuit basically claimed Danaher saw this inventory destocking coming, but hid it from investors.
And Danaher fought the lawsuit aggressively, securing a partial dismissal from a judge in 2025. But according to this new Q1 2026 filing, they have finally reached a settlement agreement. They've recorded a settlement liability on the balance sheet, but they've also recorded an offsetting insurance receivable.
Meaning their directors and officers' liability insurance, their D&O coverage is stepping in to absorb the financial blow of the settlement, pending final court approval.
Which is a very calculated corporate maneuver.
Yeah, rather than dragging out a highly publicized trial over whether they misled Wall Street on bioprocessing revenues, they leveraged their insurance to cap the downside, settle the case, and keep executive focus entirely on integrating that $9.9 billion Musimo deal.
It is the ultimate exercise in risk mitigation. Whether it's dodging margin compression in China, rerouting supply chains around Middle Eastern conflicts, or settling class action lawsuits, the entire corporate apparatus is designed to isolate risk, absorb the friction, and protect that core engine of profitability.
And as we synthesize all of this, the takeaway is that corporate resilience at this scale requires constant, aggressive evolution. For you listening, it is incredibly easy to brush off SEC filings, bridge loans, and commercial paper as abstract Wall Street noise.
Yeah, it sounds like purely financial jargon.
But the supply chains and financial maneuvers we unpack today directly dictate the reality of your local healthcare system. When a regional hospital decides they can't afford to upgrade their ICU patient monitors, or when a local clinic struggles to source the basic chemical reagents needed to run your blood work, you are feeling the downstream ripple effects of the exact economic pressures Danaher is currently navigating.
Because the volatility of the global market dictates the ceiling of clinical care. The two are inextricably linked.
Which leaves us with a final, slightly provocative thought to take away. We watched Danaher drop $9.9 billion to pivot away from the unpredictability of chemical testing and heavily into hardware and wearables.
A massive bet on the future.
Exactly. So if the largest healthcare conglomerates on Earth are betting their future on continuous patient monitoring rather than episodic lab work, will the future of medicine be driven less by the physical blood we leave in a sterile lab and more by the constant invisible stream of digital data we generate from the devices we wear?
It completely changes what a medical diagnosis actually looks like.
Something to ponder. Thank you for taking this deep dive with us today.